First of all, let's give us the basics for a moment. This year, what kind of profits are these big oil majors like a BP kind of looking at? What are your estimates showing?
For the North Sea production, which is what we've been looking at, we're predicting that the profits for the sector should be somewhere in the region of about £40 billion.
So £40 billion, Graham, and so that is something that has no doubt, got the Treasury's attention, and we know it has, and hence we sit here with this windfall tax now on those profits. What's your early assessment then of what this is going to do to investments in the North Sea? Because it's a complex tax. Yes, there's a windfall tax on those profits, but you can offset that, you can reduce your tax burden if you promise to invest. What's your early assessment of this measure?
Yeah, well, that's correct. And as you've just mentioned, BP is saying they're going to take some time to just work out exactly what this means for the investments that they were looking at. I mean, the point, I suppose, really is for companies that were looking at investing this year compared to last year, the question really is, are those investments looking better at today's higher oil price, even with a higher tax, than they were last year when the price was much lower, but the tax rate was lower? And I think those are the sort of things that are going to be probably different from company to company, because they all have different tax profiles. And then from investment to investment, different assets have different profiles. And of course, one feature of the new tax is that it's going to last for only 3.5 years, according to the government's guidelines. So there is a window there where tax is going to be higher on your profits, but as you've mentioned, there is this investment allowance, which will mean that the level of tax relief will actually be very high on those new investments for that 3.5-year period. So if you have, for example, a relatively small project, which is not the norm for the North Sea now, that you can develop over that time period, you'll be receiving the very high tax relief for the investment costs. But when the field comes on stream, because normally it'd take about 3 to 4 years to develop the facilities and bring the field on stream, if the government sticks to its plan, the tax rate will come back down again from 65 to 40%. So the profits will be taxed at a lower rate than the tax relief on the investment. So there is an incentive there to bring on some new investments now.
Graham, I'm curious, 40 billion is a huge amount of profits at this oil price. And I'm wondering if you guys know or have an idea of the oil price that these guys have to maintain in order to want to invest and be able to invest, still make the profits, deliver the tax to the government, and still pay the dividends that shareholders demand.
Yeah, well, that is a moving target. If you're talking about the break-even price required for investments to make a certain rate of return, then that critically depends not only on the tax system in place, but of course the costs of developing those new investments. And that will vary with the oil price. And we're already seeing that inflation in the sector is beginning to rise. And we would only expect that to continue as there are sort of gaps, supply gaps. There's a lot of pressure on the supply sector. Prices generally rise in the supply sector when the product price rises. So there's going to be a lot of coming together of those factors, the cost inflation, the new taxes, and prices. And of course, where are future prices going to be? They could fall quite significantly if market dynamics change dramatically, as they have done over time and including in the last few years, right? We've seen the price being down at $30 a barrel only 2 years ago. So you've got to factor all of those things in, and the companies have to attach risk factors to all of that in order to come up with what they believe are robust investment decisions that will survive all of those different market changes.
Graham, a lot of the companies that we used to refer to as big oil, they're now increasingly big energy. They are doing things that aren't just oil and gas, of course. They're doing other things. What difference to their investment decisions and the energy transition that they're trying to bring about do you think is going to be made by these announcements yesterday? I mean, if they're looking at the incentives in front of them to invest more in oil and gas in the North Sea or to by a company that operates wind farms in the North Sea. What difference has the announcement yesterday made?
Well, I think, the most obvious thing is that the value of those investments in the North Sea is lower than it was on Tuesday. So that's the first thing. Is it lower than it was this time last year? That will be a case-by-case basis. With regards to the renewable energies, I mean, it shouldn't affect those. Those are regarded as separate businesses. One thing that we've been discussing and suggesting could be considered by government is to actually think more holistically about fiscal policy for energy projects. And that might mean that you could extend the ring-fenced tax system for the North Sea oil and gas production to include some renewable energy projects. And that would be something that would be interesting to look at, because then you might have those projects, albeit taxed later at a slightly higher rate. If they get those upfront tax reliefs that are now in place for the oil and gas sector, that could act as a stimulus for more renewable energy projects.
Absolutely. And I'm wondering if that is something that to be considered, does it also bring in other sectors into a possible windfall tax? Like if you make these carve-outs, is it then okay to tax a power generator differently?
Well, you mentioned that in your introduction about the possibility of the windfall tax being extended to certain electricity generators. And that's because the electricity that's being supplied in the market gets the market price. Now, that market price has been rising very significantly because of the rise in the natural gas price, which still contributes a very, very high percentage of the UK's power. But we do have a number of renewable, there's quite a substantial renewable energy sector that is now generating a lot of the UK's power. Some of that is prone to the market price, but and some of it is not. Some of it is under a sort of fixed price contract with the government. But for that portion of the renewable energy that is getting the higher market price, driven by natural gas prices, but without having to pay that natural gas as the feed gas for the electricity, a windfall has been created. There is a windfall price effect happening for those generators. And I think that is the portion of that market that the Exchequer plans to have a consultation and discussion with, to see if a windfall tax is justified there. But again, as with the oil and gas sector, any increase in tax will immediately be criticized as a dampener on investment. And of course, that is the sector that the government is very keen to grow as substantially as possible, as quickly as possible.
Graham?